There is a modern magic to the way we buy things now. You experience the frictionless satisfaction of swiping for instant ownership, often while racking up points for free travel and luxury perks. But that plastic represents a hidden reality. A credit card is a mechanism for accessing a bank's money for a short period of time. It is a form of debt, not a reflection of your actual wealth. The mechanics are different from a debit card, which pulls money directly from your existing bank balance. When you use credit, you are borrowing from the bank with the promise to settle the bill later. This borrowing happens within your credit limit. This number represents the maximum amount of debt the bank is willing to risk on you at any given time. It is a measure of the bank's exposure rather than your financial security. Think of debit like eating from your own limited pantry. Once it's empty, you stop. Credit is more like running a tab at a restaurant. You get the gratification of the meal immediately, while the cost is deferred until the bill arrives at the end of the month. That psychological separation between getting the item now and feeling the pain of paying later is what makes the card convenient. It changes how spending feels, creating the exact conditions needed for the bank's business model to begin. On one side of the spectrum, the card acts as a tool. Disciplined users utilize the grace period, which allows them to avoid all interest charges by paying the statement balance in full every single month. But the entire system is designed to profit when users move to the other side of that spectrum. Imagine using your credit limit to buy a phone for $1,000. You see the full $1,000 debt alongside a comforting $25 minimum payment. Choosing that minimum leaves $975 on the card. This balance rolls into the next month, generating high interest that stacks on top of your debt. Paying only the minimum payment is like bailing water out of a leaky boat with a tiny spoon. You feel like you are solving the problem, but the water level continues to rise as the debt grows faster than you are clearing it. The bank uses the minimum payment as a behavioral tool. It provides just enough relief to prevent you from panicking, while ensuring the debt remains alive and generates a steady stream of interest profit. This interest is exceptionally high because credit cards are unsecured debt. This means the loan is not backed by a physical asset like a house or a car that the bank can repossess. The bank charges a premium for taking on that higher risk. High interest quietly attaches to forgettable, everyday purchases like groceries or meals out. This turns temporary convenience into persistent, long-term debt that remains long after the purchase is forgotten. Then there is the second profit engine, rewards. Points and miles function as a behavioral bait designed by the credit industry to increase usage and loyalty. Rewards shift your psychological focus. Instead of weighing the pain of spending money, you focus on the thrill of earning a reward, which often leads to justifying purchases you might otherwise skip. The math of a 2% cashback offer is clear. Spending $1,000 to get $20 back results in a net loss of $980. There is also a hidden economic layer involving merchant swipe fees. Stores typically raise their prices to cover the cost of processing these rewards, meaning even cash buyers end up supporting the perks of card users. The system maintains a perfect balance. It constantly provides just enough rewards to keep you eagerly swiping your card, while knowing a certain percentage of users will inevitably fall into the highly profitable interest trap. This brings us to the credit score, which many people view with anxiety. Your score is simply a bank's trust rating of your borrowing history. It is a predictive tool for lenders, not a reflection of your personal wealth. A common misconception is that you need to carry a balance and pay interest to improve your score. In reality, credit bureaus prioritize consistency and on-time payments over the amount of interest you pay. The verdict on credit cards is that they have a built-in bias. They are designed to make spending feel easier, and the rewards are supported by a complex ecosystem of fees and interest. Safely using the tool requires following strict rules. You must treat the card like a debit card, avoid buying anything you cannot afford with cash today, and ignore the minimum payment option entirely. Moving forward requires looking at the deeper mechanics, such as the specific math credit bureaus use to calculate that 3-digit score. There is also the matter of hidden network swipe fees, and the specific steps a user can take to negotiate lower interest rates directly with their card issuer. Real financial strength comes from seeing the system clearly enough to use the tool without becoming the product. We'll see you in the next one.